Hi, everybody. This is Fred Bruin with Remax Parkside Real Estate. It is Wednesday, February 2nd, and I'd like to talk to you about interest rates and what's going on with that. Certainly has an effect on the real estate market as interest rates seem to be climbing. Mortgage rates continue to move up. Sam Cater, the chief economist for Freddie Mac, he says that mortgage rates moved up again as the 10-year U.S. Treasury yield rose and financial markets adjusted to anticipated changes in monetary policy that will combat inflation. As a result of higher mortgage rates, purchase demand has modestly waned in advance of the spring home buying season. However, supply remains near historically tight levels and home prices remain high, keeping the market competitive. You can see in the graph below that the 30-year fixed rate mortgage is currently at 3.56. That's up from below 3% earlier, a few months back. The 15-year fixed rate mortgage at 2.79. So rates are definitely starting to inch upward. This is the Freddie Mac fixed rate from January of 2020 through to today. So back in January 2020, we were just over 3.7, dropped to under 2.7, and have started to climb back to current level at 3.56. This is a look at that 30-year fixed rate from January of 2018. And you can see then we were just under 4%, climbed to almost 5% back. Let's see, that's in 2019, and has significantly fall off to the low point here in early 2021. And you can see it's climbed back to 3.56 today. There was nothing wrong with this real estate market 2018, 2019, 2020, even with these higher interest rates, we still had a very robust real estate market with plenty of sales. As the mortgage rates rise, we do expect some moderation in housing demand, causing house price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. In 2022, they expect purchase originations, new loans, to grow from $1.9 trillion in 2021 to $2.1 trillion in 2022, while the refi market is anticipated to decrease by pretty significant numbers there, 2.7 versus 1.2. So still a very strong new loan market. The refi market is going to cool. So here's current rates over the long haul. In the 1970s, around 8.86 average 30-year mortgage. 1980s, it was up to 12.7, come down in the 1990s, down again in the 2000s, and in the 2010 decade, average around just above 4% for a 30-year mortgage. What does that interest rate do to a payment? So on a $300,000 loan, if you had a loan in the 1970s at that 8.86, your monthly payment would be $2,384. In the 1980s, higher interest rate, higher monthly payment. Look at that, $3,248. 1990s, down around in the low eights, $222.67. In the 2000s, at 6.6 and a quarter or so, $1,855. In the last decade, at 4% plus, we're looking at $1,448. See the difference in the monthly payment based solely on the interest rate. This says today, but this is a dated chart. I think today at 3.5, we'd probably be at about $1,360. So the 10-year Treasury yield that we mentioned earlier, this is what it looks like from December of 2021, whereas at 1.43 to current at 1.87. So this 10-year Treasury yield has been climbing fairly quickly. Why do we track that? Well, for almost 50 years, the 30-year mortgage rate has moved in unison with the 10-year Treasury rate. You can see that by this chart comparison from 1972 through 2021. They sure do move in unison. 30-year fixed rate is slightly higher, 1.7% spread. So what does rising interest rates mean? What's it going to do? Well, it's going to certainly affect affordability. Affordability is a three-pronged monster. It's the value or the price of the home. It's the cost of money or the interest rate that we're talking about today, and it's wages. So if income levels are climbing and interest rates are declining and house prices are stable, it should be an affordable market. But with these interest rates rising and home values rising because of the limited inventory, affordability is going to be significantly affected, which will slow the rate of property value appreciation or the increase in home prices. And this is a look what they're anticipating over the next 2 or 3 years, that this year will be significantly lower than it was in the previous 2 years. And then in 2023, 24, 25, we should return to much more normal type property value appreciation between 3 and 4%. So there you have it. Interest rates certainly do affect the real estate market, and that's what we think is going to happen here in the short term. If you have any questions or need more information, please give me a call at 805-235-4681. Or you can email me at fred@fredbruin.com. Thanks for tuning in, and we will see you next time.